Hi, this is Jim Cunningham. We have a great webinar. This is all about partnership versus corporation versus LLC and how can you save taxes as a business owner. You don't want to miss this. This is a good one. Hi, this is Jim Cunningham, and we are going to talk about business owners and some key estate and tax planning issues. These are issues we're going to talk about that lawyers do not pay enough attention with their clients, and CPAs oftentimes don't as well. So I will tell you, guilty as charged. I have not, if you're watching this and you're a client, and you're like, this is all new to me. This is something that lawyers really should be focusing more on with their business owner clients. So little teaser, not this week, next webinar, December 8th, we're going to look at how wealthy people structure estates to reduce taxes, death taxes, income taxes, whatever it is, gift taxes. We're going to talk about all of that December 8th, and there's a QR code if you'd like. You can click that and sign up for the webinar. So we're talking here about business owners. So, business owners have unique estate and tax planning needs. It's different than a W-2 employee. The W-2 employee takes the security of California labor law, number one, right? They also take the security, the W-2 employee takes the security of a regular paycheck. The business owner is an entrepreneur. That's a French word for risk taker. So business owners many times are the ones taking the risk, and there are some rewards to reap for taking that risk. So the government doesn't always punish you. For those of you who are business owners bemoaning those difficult days where you're like, why am I doing this? There are some really good benefits, and we're gonna cover those. So we're gonna cover really one big topic, and there's two other topics that come from this. When should you use a partnership? When should you use a corporation? When should you use an LLC? Because those are three very different ways of conducting business. Some of them have great tax attributes. Some of them are completely the wrong fit. These are tools, no different than like a screwdriver and a saw and a paintbrush. You can't paint your house with a screwdriver. I mean, I guess you can, but that's not a good idea. Use a paintbrush, right? So these are the three different kinds of tools that we'll talk about as we go through the materials here with you. So there are some special provisions. If you do have a corporation, especially an S corporation, you do need to have those in your living trust. That is very, very important, because if you don't, it can really disrupt the apple cart when it comes to saving taxes. And then we're going to talk about several ways to reduce your tax bill. And I would say this is what we call low-hanging fruit, right? This is a way to reduce your tax bill. And I say with little effort. I'm not talking about moving big chunks of capital around. I'm just saying, look, this is basic business owner tax hygiene. All right. So let's get started. I'm Jim Cunningham, your speaker. I've been a lawyer for 25 plus years. When you reach 25, you just put a plus behind it. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law, a real estate broker, securities and insurance licensed, and a pilot. Not active current, but a pilot. These are our 9 lawyers at our firm, and each one kind of focuses, well, everyone focuses on trust and estate. Some are more focused on business owners. Some are more focused on high net worth individuals. Some are more focused on, hey, mom and dad passed away. Now, what do we do? How do we work through all this? But we have a full complement of lawyers kind of all over the state of California. Very important. I'm a lawyer. I'm talking. It's a little bit of a rant. Okay. I'm talking. This is not legal advice. There's no attorney-client relationship, right? If just by watching this video. In other words, don't watch this and go, hey, that looks like a good idea. I'll go do that, right? You don't want to do that, right? You really, this is pretty complex stuff, and there are several things you have to do correctly and in the right order. And if you screw up one of those, you got some real problems. So when and whether to use a corporation, partnership, or LLC, that's a really tough one. And I will tell you, I try and look at this material with fresh eyes, and I put myself in the situation that you might be in, which is, having little or limited knowledge. When I started as a lawyer, there were a lot of questions that I was just frankly afraid to ask. I'm like, this is the dumbest question. Like, I really should know this stuff coming out of law school. And the secret here with law school, by the way, is they teach you how to think like a lawyer. They don't teach you how to practice law. And, if you're a lawyer watching this, you'll say, yeah, that's basically what law school is, learning to think like a lawyer, not necessarily the practice of law. So I'm going to be kind of addressing some very fundamental things. I think this is very high value information, and I want to be respectful of your time if you're watching this, but we do need to go through this a little bit methodically, and we're going to spend a fair amount of time on there. And there are some special provisions that I mentioned that need to be in your living trust, and you will see a way to reduce a tax bill by almost 10%. Okay, for our example that we'll see, almost 10% by just doing some basic, folks, this is like basic stuff. Now, when I say basic, it's complex, it's routine, it happens all the time. It should be done with an expert, okay? So a corporation or a partnership or an LLC. So what are we talking about here? So a partnership is a business, right? So two people come together, they form a partnership, and we have an example here. A corporation, so in that sense, partners, when we talk about the term partnership, it is typically two or more people actively engaged in the activity of the business, right? Ben and Jerry, they're partners. They're one's stirring and one's scooping or whatever it is, right? Ben and Jerry's ice cream. So those are two people. A corporation is a real separation between the ownership of the business and who's running the business. So many times the members of a corporation, so the shareholders of a corporation, they might have a vote on who a board member is, but it's the board that appoints the executive team that runs the corporation. So a partnership is fundamentally different in that a partnership typically involves the people who are active in that business are the owners. So they're active owners. Corporation, you can be an active owner, but many times what we see is it can be a more passive activity, not necessarily, but that's really the fundamental structure. Is there's a real separation from ownership and control, frankly, on a corporation that you don't as much see in a partnership. Now, in a corporation, there can be a single owner of all the shares. For example, if a lawyer creates a law corporation, and if you're a lawyer watching this or other professional, California makes you do a corporation. You cannot do a professional LLC in California. So in a corporation, one person can own all the shares. One person can be the CEO, the president, the secretary, the chief bottle washer, right? One person can have all those roles. In a partnership, it takes two to have a partnership. So it takes two to tango, as they say. So as we go through this, and when you think about your own situation, you go, wow, well, I don't have any partners. I think a partnership's kind of off the table if you don't have any partners. And now you will see a way where you could have a partnership. But I would say if it's just you and it's just your business, I would say most of our clients look at a corporation or they look at an LLC, and we'll see the difference between the two and why one might make sense when the other one doesn't, or vice versa. So we'll talk about that. So what about an LLC? The LLC is just this great, it's a very modern form of doing business. LLC stands for Limited Liability Company, okay? Now, an LLC has a lot of flexibility. It can be taxed like a corporation, an S Corp or a C Corp, and we'll talk about what that is. It can be taxed as a partnership. An LLC can be taxed as a partnership, but you need two to tango, right? You need two people in the partnership. Or it can be taxed as something called a disregarded entity. Now, a disregarded entity, what that means is you typically file a state income tax return, but no federal income tax return for a disregarded entity, and all that information is reported on your individual 1040. So I know I'm getting a little weeds on that, but it's very important to understand that there are three. The LLC, remember, there's an L, an L, and a C. There's three letters in there. It can take three forms: corporation, partnership, or disregarded entity. But we'll cover that in depth toward the end of the materials here. So there are two flavors of corporations. There is the C corporation and an S corporation. Apple is a C corporation. The guy who repairs the broken Apple phones at the kiosk in the mall, if he is incorporated, probably an S corporation, right? So dealing with the same Apple products, but typically your C corporations are going to be larger corporations. S Corps are fairly recent. So, in the 1950s, you only had a C Corp. Well, what's the difference between an S and a C? They follow the same laws in a sense, but the S and the C means that they're taxed differently. So corporations, the C Corp like Apple, pays their state income or their federal income tax and their state income tax. They're supposed to. Or if you work at Apple and you're a tax person, you know what I'm talking about. And that's been in the news a lot, right? So they say, oh, well, we'll spin this company off in Ireland because they have a lower tax rate. And then, basically most of the world governments kind of got together, like, guys, you need to pay a minimum 15%. So that looks like that's the way it's headed. So at least some minimum if you're over $1 billion in revenue. But again, these are massive corporations. So really for most of our clients, we have legacy C corporations. So we have many clients who are farmers or ranchers, and they might have legacy properties in a C corporation. That's a real tough tax problem, and we'll talk a little bit about that. But corporations fundamentally are primarily used for what we call operating businesses. So if something is taxed as a corporation, it is an entity that is running an operating business. So Apple is an operating business. They design stuff, they contract to have the stuff created, and then they distribute to us, the consumers. That is an operating business. A non-operating business would be, owning a piece of real estate. Now, many times that'll be in a partnership or an LLC. So, we'll cover that in a little bit. So, so the operating businesses do have some advantages that the partnerships and LLCs not taxed as a corporation do have. Again, professionals must operate as a corporation, at least in the state of California. Other states do allow LLCs for professionals. And the corporations have something that are called corporate formalities, right? You have to have that annual meeting. You have to dot your I's. You have to cross your T's, or else pierce the corporate veil, right? The or else. So C Corp is a traditional corporation. Tax is paid at a flat rate of 21% plus 8.84% California state income tax, which is 29.84%. But you have to pay dividends when the money comes out. So this is very important. The corporation pays us 29%. And when you take that dividend, that's going to be income to you. And it's going to be taxed at however that's going to be taxed. And there are a lot of different ways that that's taxed. But the bottom line is that is going to be taxable to you, right? That's so taxable when the corporation makes the money. And then when they turn around, they've distributed dividend, taxable to you as well. So it's the same money, taxed twice. They're great tools. They can be great tools, but most small business owners are S Corps. This is what we call a pass-through structure, meaning all your income, all your tax credits, all your deductions and losses, those flow through to the shareholders in proportion to their ownership of the corporation. And that is really important because one of the constraints of a corporation, if you're running a business, if you are running a corporation, there are shares in the corporation. It is a rather rigid structure. So if there are two partners and one partner is doing 80% of the work and the other partner is doing 20% of the work, and they are 50-50 partners, those two partners might agree, hey, this one partner should get 80%, I should get 20% distributed through the partnership. In an S Corp, that would have to come out as compensation in order to do that settling up, because those dividends have to be distributed 50-50. Okay, so, and we'll have an example in here that kind of walks you through that. Very important that an S Corp has some limitations. If you set up a corporation and you do nothing, you have just made a C Corp. Okay, you need to file Form 2553 with the IRS, which is election by a small business corporation to be taxed as a flow-through corporation. And if I'm losing you on this, I promise I'm going to bring it home. I'm going to give you an example where it all makes sense. 100 or fewer shareholders, it used to be 35. And then this is where the tax savings comes in. Dividends versus salary. If you work, you're going to have to pay Medicare tax of 3.8% and self-employment tax of 15.3%. If you work, you're going to have to pay that up to $147,000. I think that was last year or this year when I was preparing for it, but that number goes up every year. So what I'm going to show you is a way where you can take a salary and then take the rest as dividends, and we'll see what the tax savings is. And that, I will tell you, for many of our clients that have operating businesses, many of those operating businesses are corporations. Our clients do take a salary, they do take the rest as dividends, and many of our clients are saving over $30,000 a year in income tax. So it's a very powerful strategy. The other thing a corporation has, and there's an intangible to this, you have credibility with your customers, your vendors, your employees, your suppliers, investors. It shows that you're serious about a formal commitment to the company by incorporating and doing all the things that you need to do when you have a corporation. Okay, so Owen is a coffee roaster. So he owns a coffee roastery and makes $1 million a year. This is a little bit of an homage to Winston in our firm. He loves coffee. So Winston, this one's for you. In O-Town Roastery in Oakland. Okay, I'm making this up. There's no O-Town Roastery. But so Owen's the owner. And before incorporating, so Owen's out there, he's he's roasting the beans, he's putting in the bags, he's handing it to people, he's at farmers markets or whatever it is, but he makes $1 million a year, right? This is a great business for Owen. Before incorporating with an S Corp, Owen pays $457,000 in tax. Well, Owen comes to us and he's like, Jim, I saw your video. I got this business. How do I pay less in tax? Well, after creating O-Town Inc., we'll just call it O-Town Inc., O-Town Coffee Inc., Owen pays himself a salary of $42,800, which is the going rate for a coffee roaster in Oakland. I actually looked this up. I love Google. Thank you, whoever's working on Google. If you're working at Google, thank you. You know, how much does a coffee roaster make in Oakland? It pops up. This is relevant because you have to pay yourself a salary. You have to pay yourself a reasonable salary, right? And so that's one way of looking it up, is kind of looking at the Department of Labor statistics and, oh, what do coffee roasters make? By doing this structure, Owen saves $34,000 a year in tax. Now, I don't know about you, but $34,000, even if you are very wealthy, is a lot of money, okay? That's every year. That's $34,000 less in tax that Owen is paying. Now, what Owen does is he sets up a corporation, he makes himself an employee, he takes a $42,800 salary, and he takes the rest as dividends, and he saves himself about $15,000 in self-employment tax, as well as a good chunk on Medicare tax as well. So very, very important. If you're running an operating business as a sole proprietor, by the way, you're about 20 times more likely to get audited if you're a small business owner and you report all that on your Schedule C versus a corporation. It's because a corporation has to file a balance sheet with its income tax return. It files an 1120S. That's the form for an S Corp. And those have a much lower incidence of getting audited. Now, it's no guarantee that you won't get audited, but it just is a fact. It's fewer audits. So real estate and corporations don't go well together. And it's hard for me to understate this. They really don't go well together. Owning real property in a corporation, whether it's a C Corp or an S Corp, is generally a really, really bad idea from a tax standpoint. So number one, you do not get an adjusted cost basis at death. California has this quirky rule, and the other community property states have this quirky rule. If you are married, all community property gets an adjusted cost basis when one spouse passes away. So husband and wife, they're married, they buy a piece of property for $100,000, it goes up to $1 million. Husband dies, wife can sell that property for $1 million and not pay any capital gains tax, saving $300,000 in taxes, $400,000 in taxes, right? That's a really, really big deal. And so if that property's in a corporation, the underlying property does not get an adjusted cost basis, even if it's in an S Corp. It's very, very important. If you have property in an S Corp, take it out, wait 5 years, you get more favorable tax treatment. Now, I'm not suggesting that if you own property and it's in an S Corp that you do this, but this is where you need to get together with your A team, right? Your savvy advisors, your CPA, your financial advisor, your lawyer, maybe a realtor, and think about this, because you know, this is a tax problem that's not going away unless you do something, right? So if you own property in an S Corp, that is potentially a real serious problem. And talk to your advisors. And if you don't have advisors, reach out to us and we'll be happy to kind of walk you through that on a strategy. And it might be a multi-year strategy to get that property out of the S Corp to get more favorable treatment. So most people, so the normal way of holding real estate, if you don't hold it in your own name, which there's, you know, a lot of cons on that one. But if you're going to hold it in an entity, most people will have it in a partnership or an LLC taxed as an LLC taxed as a partnership or disregarded entity. I know I'm throwing a lot of technical terms at you, but it's very important to understand. I want to make this very clear. If you're going to go buy a piece of real estate and you want to have an LLC buy that property, you're going to probably end up with it having taxed as a disregarded entity if it's just you, or a partnership if there's two people buying it. Now, California has an interesting rule because it's a community property state. A couple can own an LLC, and if they're the two shareholders of the LLC, the two people who own all the LLC, you can still file as a disregarded entity, but not in a separate property state. So if you're an attorney watching this, and you might be like, wait a minute, disregarded entity couple. Yeah, if you're in New York, you can't do that, but you can in California. So make sure your living trust has S Corp provision. So this is very, very important. If you own S Corp stock, and you might own S Corp stock and not know it, you might inherit S Corp stock. So it's good to kind of, if you have a living trust, it kind of should be in there, frankly, anyway, because you might have an investment that's an S Corp, you know, who knows? The language includes technical references to the Internal Revenue Code, and that lawyers abbreviate that IRC. There's like the IRS, and the IRC is the Internal Revenue Code. The trustee can elect to qualify the trust as an electing small business trust, or the beneficiary can make a qualified subchapter S trust. But these provisions have to be in the trust. So I'm not going to get into legal technical, but something to know is if you got one of these flaky 8-page living trusts and you have an S Corp, these provisions run a couple pages. Okay, so you probably don't have that in your, if you have one of those 8-page trusts, you're not going to have these provisions. So if you have an S Corp, very important that you understand this. And again, speak to your advisors. If you don't have advisors, reach out to us. So 2 kinds of partnerships. We're gonna shift gears here. And if you guys have any questions, go ahead and put them in the Q&A. If you're watching this on YouTube, go ahead and put that in the notes. We do look at these notes quite often, but there are 2 kinds of partnerships. They're general and limited partnerships, and the 2 are very, very different. So a general partnership means that each partner, and again, it's 2 to tango, so at least 2 come into the dance, right? You could have 5 people as partners. Each partner is what we call a general partner. So a general partner assumes, and this is very important for you to understand, unlimited personal liability, unlimited, potentially subjecting all of the partner's personal assets, all of them, to seizure taken by creditor if that partnership becomes insolvent. And I'll have an example for you here. So I would say this is having a general partnership, running an operating business with a general partnership, kind of a bad idea. I'm just on a very high level, okay? And again, you have protections in a corporation, and we'll talk about that in our example, but generally not a really good idea to run a business as a general partnership. If you're going to, if the partnership is going to incur debt or incur some liability, all the partners must agree. You should have a written agreement, but many people don't. They're just like, hey, do you want to go into business together? Sure. And you go into business together. Well, it's 50-50. Okay, we'll figure it out, right? But oral agreements are valid. Of course, proving an oral agreement is kind of tough if you don't have a writing. Each partner shares in the partnership's debts, liabilities, and assets. So if it's a general partnership, unless there's an agreement, it's kind of, if there's 2 people, it's 50-50. If there's 5 people, it's everyone's 20%, unless there's some written agreement or some other oral understanding. It is less expensive to form compared to a corporation. In fact, it's free because you can just start doing business with somebody and not register anywhere, okay? Not a good idea, as we'll see. So Abel and Baker agreed to go into business together as partners to make ube-flavored ice cream. And I'm using these kind of different examples because I want you to remember this. Ube is a sweet potato root from, I believe it's from the Philippines, or somebody correct me if I'm wrong. You can message. It's great. It's a great ice cream. And so these 2, Abel and Baker, they say, you know what? We love ube ice cream. The world loves it. Let's make great ice cream. So they start making ube flavored ice cream. It becomes wildly successful. They never register their general partnership with California. They're not subject to the $800 a year minimum franchise tax. Each of Abel and Baker has unlimited liability, and they have no written partnership agreement. So, you know what's coming, right? They hire Charlie to drive the truck to deliver the ice cream. So here's Charlie driving the ice cream truck, making a delivery on behalf of the partnership. Well, he's rear-ended by a drunk driver. That drunk driver pushes Charlie into a van carrying 10 physicians. All 10 physicians become paralyzed. Charlie is deemed 1% at fault. Now, you may be asking yourself, how on earth can you be 1% at fault if a drunk driver hits you and you get pushed into somebody else? This is not uncommon in the law, but something you need to understand, especially in California, Abel and Baker are jointly and severally. Now, jointly means together they're 50-50 responsible, and each one is 100% responsible. They're jointly and severally responsible for the special damages, which are the medical bills, 100% of the medical bills, even though they're at 1% at fault. So that's a very special rule, right? It's a very esoteric rule, but in California, it's a real rule. So the medical bills for the doctors will exceed $300 million. Abel and Baker, each 100% responsible. They'll get wiped out under that scenario. They'll lose all their assets, right? We have some questions here. Anita asks, can a general partner have two general partners and the rest are limited partners? Yes, we'll get to that. But that's a limited partnership. And, oh, yep, the Philippines. All right. Charlie is an employee. Yes. Ube's from the Philippines and Charlie is an employee. So he's an employee. So there's agency liability on the part of Abel and Baker have agency liability for Charlie making a delivery. I use the ice cream truck because if we meet with you, the euphemism for dying is, well, let's say you get hit by an ice cream truck, or let's say you get hit by an ice cream truck and don't die, right? That would be incapacity. So you may hear us talking about getting hit by ice cream, beer truck, ice cream truck, take your pick. So let's talk about limited partnership. And Anita, I think this will answer your question. A limited partnership is a variant of a partnership. So if you don't have any agreement and you don't have anything set up, it's a general partnership. In order to be a limited partnership, you have to have one general partner and one limited partner. The general partner oversees and runs the business, and the limited partners don't. They're along for the ride. In fact, they look a lot like a shareholder, but many times they don't even have a vote. Okay. So there are structures where the limited partners, for reasons that are outside of the operation of the business, but more transfer tax reasons, where those limited partners may not even have a vote. Okay. So the general partner of a limited partnership still has unlimited liability. Limited partners have limited liability, hence the term limited partner, up to the amount of their investment. So if a limited partner puts in 100,000, they can lose that 100,000. But if there's no, they can't come back to the limited partner for more, unless they're deemed a general partner. But the idea here, I'm trying to make this clear, that limited partners are limited to the capital that they put in into the partnership. These are pass-through entities. So these partnerships, they file a return, but they don't pay taxes. They pass that tax liability through to the limited and general partners. Now, unlike general partnerships, most states in the United States do govern the formation of a limited partnership, and that does require registration with the Secretary of State. So it's not like this freebie where you can't accidentally become a limited partner. You're going to have that registered through the state. So let's go back to our Abel and Baker and the Ube ice cream. A little bit different. So Abel Inc. So Abel has created a corporation, and Baker, individual, agreed to go into business together to make Ube flavored ice cream. Abel Inc., Abel Incorporated, the president of Abel Incorporated is Abel, but Abel Inc. is the general partner and Baker is the limited partner. The limited partnership in California is going to be subject to that annoying $800 a year minimum franchise tax. And if you're watching this and you go, yeah, that's why I'm not doing one of those LLCs, I don't want to pay that $800 a year tax. You need to look at the big picture, okay? And if you have 10 million in assets and a bunch of rentals, or 100 million in assets, are you really worried about $800 a year? And this is the conversation we might have if I talk to you or someone in our firm talks to you. There's a little bit of I say this respectfully, a little bit of a get over it, right? Sometimes you need to break some eggs to make an omelet. If what you're getting is limited liability, I think it's worth the price of entry, probably a lot less than insurance premiums for a year. So Abel Inc. is subject to the $800 minimum franchise tax as well. So that's $1,600, okay? Abel Inc. has unlimited liability, but Abel does not. Abel does not individually. So remember, before, Abel and Baker were general partners. Well, here, Abel says, well, let's do this limited partnership structure. I'll set up a corporation so that I'm only limited, my loss is limited to the amount of money I put into the corporation. And then Baker, your loss is limited to the amount of money that goes into the limited partnership, so that we are limiting our liability. Now, if this seems like a very complex structure, it is, and there's a better way, but this is kind of the old way of doing things, kind of up until the 80s-ish, maybe early 90s. They do have a written partnership agreement. Again, they hire Charlie. He's an employee to drive the Ube ice cream. Charlie's making deliveries. Same thing happens. Charlie's deemed 1% at fault. The limited partnership itself is jointly and severally liable for special damages, right? Not Abel and Baker individually. Abel Inc. is responsible as a general partner, but only to the extent of the capital that Abel has put into Abel Inc. So the medical bills for these doctors still exceed $300 million, but they're not. This is not going to ruin Abel and Baker. So, a limited partnership is a clunky way to run a business. A general partnership is a risky way to run a business. There's a better way, okay? Because this stuff gets really complicated really fast. And it's been said, a famous Italian philosopher said, if I had more time, I would have written a shorter letter. And when we meet with clients and we're doing this stuff, it's a lot of talking. It's a lot of figuring out what to do. It's measuring 19 times and cutting once, which can be frustrating for a client because they go, how come this isn't going fast enough? But it's like, wait a minute, there's a lot of considerations. We have to talk to your CPA. We need to figure out what's going on in your business. So Anonymous asked, with a C Corp, is there a limit of minimum yearly salary to be taken by the owners based on the income? The C Corp, I don't know that there's a minimum salary as much because the C Corp is paying its own taxes. I would say that, you have to fairly pay people. Certainly in California has a lot of labor laws and you have to follow the law, even if it's a C Corp. So in terms of how much that salary should be, it should be a fair salary, right? But with the C Corp, you're going to be paying tax at the C Corp level and then on the dividends. So if you have an operating business in a C Corp, I would really examine that. And, does it make sense to stay as a C Corp or does it make sense to convert to an S Corp? And there is a process to do that. If there's no income on a C Corp, how many years can you continue C Corp with losses toward expenses while working to get business? Corporations last kind of indefinitely. I would think Anonymous, that's going to be case specific in terms of how many years you can operate a business. I suppose as long as you're paying your registration and you're current and you're not canceled, the corporation, lives on as long as the state charter will let it live on, or as long as the bylaws let it live on. Let's see here. Okay. So a limited partnership is complicated. It is an older way of doing things. And sometimes clients have these legacy entities and there's just slightly more care and feeding. There's a little bit more elegant solution that we're going to talk about, which is the LLC. And so an LLC really takes the best of the corporation and the partnership and puts it together. It's a little bit like a Reese's peanut butter cup, right? If the corporation's the chocolate and the partnership's the peanut butter, your LLC is like this nice little it's better in many instances. An LLC is better than either the corporation or the partnership, but not all instances. And it really depends on what you're doing. Anita asks, in a limited partnership, aren't the funds in the LP Abel and Baker's funds, so they are somehow affected indirectly? Yeah, I mean, the question is, there on the limited partnership, yes, you can lose your capital. So if that accident happens, yeah, that creditor would seize the assets of that partnership based on some tort liability. So a corporation, it's like a corporation, a partnership. If they had a baby, it'd be an LLC. LLCs, again, bring the best of both worlds. But again, this is not for all business structures. So it really hinges on the facts, FACTS. It also hinges on the guidance from the CPA. And I will just share with you something, a little bit of insight. What I'm talking about here falls between the cracks primarily of lawyers and CPAs. And the problem is when you get to these areas that involve both professions, it takes two people. It takes those two professions, in my view, to get this 100% right. And I'm the kind of lawyer, if you have a CPA or financial advisor and you want me or someone in our firm to work with that person, we're happy to work with them. And we really come in and we listen to people. Look, if we recommend something and the CPA says, well, have you thought about this? No, good point. So we're not the, I think lawyers oftentimes are painted as having these massive egos, but we're very open-minded when it comes to learning and learning new approaches. So limited liability company can be one person like a corporation, and that is called a single member LLC. So SMLLC, you might see that abbreviation. It can be more than one person like a partnership. So it can be one person. It can be a couple. Remember I said in California, it can be a couple, disregarded entity, but not New York. It can be taxed as an S Corp. And that has your pass-through tax and tax savings. And we'll revisit Owen and O-Town Coffee and see why an LLC is probably a better, might be a better vehicle for him. But, professionals can't typically do LLCs. You can be taxed as a partnership, but again, you need two people to be taxed as a partnership. And in California, married couple with community property, they can opt in to the partnership. Why would you want to do a partnership or not versus a disregarded entity? If you do a partnership, you have to file an additional tax return, the Form 1065, due every March 15th. So that's just an extra, again, headspace And this kind of goes to the comment that I made of, I would have written a shorter letter if I had more time. So we meet with a lot of clients. They have a lot of legacy entities. We're like, why do you have all these entities? Well, the lawyer said to do them. Well, it might make sense to go from 6 to 3. And we're doing that for a client right now, right? We're taking more and condensing them, and it makes sense. So the LLC has less stringent corporate formalities, less risk of piercing the corporate veil. If you don't have your annual meeting, arguably that corporate veil can be pierced. And that a corporation has an annual meeting, a limited liability does not have an annual meeting, not a requirement. So it personally protects owners from LLC liabilities. But something to understand is you're always responsible for your own negligence. So if you have a company, and let's say it's an LLC, and you're the one driving the truck to deliver the ice cream, you are always going to be responsible for your own personal negligence. But what we're talking about here is a little bit is vicarious liability. So the negligence of other like employees, and being protected that way. The regulations of LLCs are not federal. They vary from state to state. The reporting requirements vary from state to state. New Mexico tends to be a very private state. Wyoming tends to be a very private state. California is the opposite. You kind of have to put, who are the managers? What's the street address of the business? You have to put a lot of information out there. And so for many people, they say, well, I want to choose a different state. And you can choose a different state. So for many clients, when we meet with them, and we'll be talking about this at our next webinar on December 8th, sometimes we use a Wyoming LLC, and we might use a California LLC and a Nevada trust, right? So we get to pick and choose from these different jurisdictions because it's America. We got 50 states. It's a great, great country. So we get to choose the most appropriate or the best state laws. Any individual or entity can be a member of an LLC. So LLCs have members, corporations have shareholders, partnerships have partners. So member, shareholder, partner, for our purposes, are kind of synonymous. They're kind of the same people, right? They're the people who own the interest in the entity. Banks and insurance companies cannot be a member of an LLC. So a little bit of a wrinkle there. LLCs do not pay taxes on their profits directly. They're passed through to members. We will cover briefly AB 150, and that's a California thing where you can pay your state income tax from your LLC and pick up a federal deduction beyond the $10,000 SALT cap. Stated another way, you can only deduct $10,000 of state and local taxes in California, or federally now, right, since 2017. California has a workaround. If you have a business, right, if you have an LLC, partnership, corporation, and it's you can pay taxes from the entity. In most cases, there's an exception. If you're a single member LLC, your living trust might have to own a part of it, maybe 1%. And I'm getting totally in the weeds on this. But the bottom line is, in many instances, our clients are paying their state income tax liability from entities. And so they end up being able to deduct that. They also pay at a flat rate of 9.3%. So a little bit of tax savings there. So let's look at Owen at O-Town Roastery. Remember Owen? He makes $1 million a year, net income from O-Town Roastery. Before creating his LLC, he paid $457,000 in taxes. After creating O-Town LLC, now this is an LLC taxed as an S Corp, okay? And this says 2 kinds of corporations, but this should say LLC. Sorry about that, if that's confusing you. This is an LLC taxed as an S Corp. So Owen still pays himself a salary of $42,800. After creating the LLC, Owen's tax bill is $415,000. Now, with an S Corp, his bill was $423,000. That's because S Corps have a 1.5% tax on profits. Now, I told you that S Corps don't pay tax on their profits. In California, they do. They pay 1.5%. Okay. This is in addition to your state income taxes that you pay individually. So by doing the LLC structure, we're able to bypass, this is really important, by doing the LLC structure, we're able to bypass that 1.5% tax. And there is a $6,000 flat tax on this LLC based on its receipts. So that's less than the 15 or 13.5 that would be paid if you're following me on the numbers here. So when we talk to Owen about, hey, should I do an LLC or an S Corp? We run the numbers. How much are you going to make? How much you've made in the past? What do you think you're going to make in the future? Do you have any employees? So in this one, he's going to end up better off with an LLC taxed as an S Corp because he's going to save another $7,500 by bypassing the 1.5% by bypassing the 1.5% tax in California. So again, it makes sense to run an economic model of the S Corp versus the LLC. LLCs taxed as an S Corp are taxed differently in California than corporations taxed as an S Corp, if you're following this. So very important. You need someone, and you can see why when I mentioned this falls in the cracks between law and accountancy, it's obvious, right? Because I think a lot of lawyers are not business owners. Something to understand. If you go to a lawyer in a big law firm, they don't necessarily know about business, right? I know about my law business because I've been doing it for 27 years, 25 plus. So it's important to understand, you need to find the lawyer who understands how businesses work and how taxes work. And again, this is between CPAs and lawyers. So we talked about business owners. They have unique tax and estate planning needs and opportunities, way more complex than W-2. And if you're a W-2 person watching this, you might be telling yourself, I need to get a business, right? So many people we talk to are high W-2 earners. And if you see any of our solar webinars, that's a business. So if you're a W-2 earner, you can invest in that. And then you get a lot of these benefits. So fantastic. So we covered when and whether to use a partnership, corporation, or LLC, and the special provisions and the ways to reduce your tax bill. And our offices, I happen to be today in our Pasadena office. So visiting everyone in Pasadena. And we've got offices in Northern and Southern California. And if you're watching this on YouTube, please subscribe. This will pop up in your feed. We do these most weeks, a couple of weeks, for holidays or what have you. I didn't do one on Thanksgiving. And if you enjoy our webinars, please review us on Google. So each of our offices has a Google location. And when you call us, and I'll get to some questions here in a minute, when you call us, what happens when you reach out and call us? Or reach out online and schedule an appointment, okay? When you call in and you're going to be talking to a client specialist, not the attorneys don't answer the phone. This is not the FBI. If you've ever called the FBI says, hello, FBI. Are you an FBI agent? Yeah. Well, we don't do that. We don't answer the phone. Our client specialists answer the phone. Let us know if you want to update or create an estate plan or some type of documents or some planning, or if someone's passed or if someone's become incapacitated, because that's a big fork in the road. If you say, hey, I'm calling and, my mom's not doing so well and I'm named successor trustee, that goes really to a different department. If you say, hey, I saw your video and I want to set up a corporation and I want to pay less tax, great. Then that goes a different way. But tell us, in brief terms, your estate and tax planning goals. Please don't ask for pricing. Only attorneys can quote legal fees, and only attorneys can give legal advice. So the point of the call is to set an appointment with an attorney. It might be a 15-minute chat with a lawyer. It might be an hour engagement. They can walk you through on that, what's appropriate for you. And again, we're going to have how wealthy people structure estates to reduce taxes all around. That's going to be a good one, and very key at the end of the year. And we will now open it up for questions. We've got a few more minutes here. I'm going to endeavor to answer these questions, and you can put those in the Q&A. What is taking dividends in a C Corp? When do you take dividends? You take dividends when the board typically declares a dividend. So the board says, hey, we have 100,000 in profit. We're going to distribute a dividend of $50,000 to the shareholders. If there are 50,000 shares, everyone gets $1. But that's typically decided on the corporate level when to distribute dividends. Anita asks, in an LLC, do the limited get to write off expenses as well as filing individual tax forms on profits? In an LLC, and it depends. So an LLC is a business. So if it is a business, you would have all those deductions, credits, expenses. Yeah, it's a legitimate business, an LLC. How does Owen's case work for a C Corp? Well, in Owen's case, he would take it's a very good question. He would take a salary of $47,000. There would be $900,000 in profit, taxed at 29.83%. And then whatever's left over, once that's distributed to Owen, he's got to pay income tax on that. So it's going to be taxable to him, depending on how it's taxed, but it's going to be taxable to him. When would you say high W-2 employee? Anyone, if you're married filing jointly or single, and you are spending less than is coming in, you have some money left over to do some tax planning. That's kind of the bottom line. But I would say the cutoff's probably, 500, $1 million, something like that. If you're married and you each have W-2 earnings of 400,000, yeah, I would put you in that category. If you're individual at 4 or 5, yeah, I would put you into the high W-2 people. Are there annual meeting requirements for an S and C Corp? Yeah, there's an annual meeting. It'll be in the bylaws. So a corporation will have bylaws. A limited partnership will have an operating agreement. Is an LLC best for Owen's case? Well, in this case, I'm not giving the full story because that was his profit. So what he could do is he could set up an LLC that does contract work for another company that sells the $10 million in coffee or whatever it is. The LLCs have a gross receipts tax that caps out at 5 million in revenue, and I believe it's like 12,600 something now. So again, this is an economic analysis, and we look at S Corp. Is S Corp versus LLC taxed as an S Corp on an operating business. It's like one or the other, one or the other. It also depends on what state you're in, right? So California is a very taxing jurisdiction for S Corps, right? You have to pay that 1.5%, which is 15,000 on $1 million. Not a whole lot, but money's money. So in LLC was a best in Owen's case, correct? Because he paid the least tax. Do you need to take reasonable compensation for rental activities in an S Corp? I'm not sure, Anonymous, what that question is. If the S Corp owns property, if the S Corp is managing property, that would be different. So many of our clients will have, if you have 10 properties, you might do 10 LLCs, one for each property. You might have a holding company for a lot of reasons. There's some asset protection reasons there that holds the shares of all those 10 LLCs. And then that holding company can pay comp, or you can have a separate corporation that contracts with the holding company so that the holding company is typically taxed as a partnership. And then if you have a separate consulting firm that's consulting to the partnership, now this sounds overly complex, but the benefit is you're going to bypass Medicare tax. You're going to bypass the self-employment tax. You might, just depending on how the numbers work out, but many of our clients do have a corporation that does the property management for partnerships. Because when you model this out economically, it results in the payment of less taxes. Even though there's more headspace and more accounting, you pay less tax. Is there an income level where the S Corp or LLC is not recommended? Yeah, I mean, if someone's making under 100,000, I'm not sure it's worth it. But if you're making 200, it depends on what you're doing. 250, 300, yeah, that's where you start looking at it. But again, it depends on how you feel about paying taxes. And we've been talking about themes. We're coming toward the end of 2022. I've talked a lot about people's attitude toward money. The flip side of that is people's attitude toward taxes. Some people, they just say, look, it's not a big deal if I'll just make more money. Other people, it turns them beet red and they get really mad and they think about moving to Nevada every time they have to pay California taxes or someplace else. I don't know. It just depends on your view on taxes. At 200, the savings, I'm not sure the savings outweigh the cost, the care and feeding of a corporation, but certainly at the $1 million level, they absolutely do. And also remember, you are much less likely to be audited if you have a corporation than you report on your Schedule C. So, I mean, that's huge peace of mind, right? Who wants to get audited by the IRS? Is it one LLC for one rental property? Yeah. I mean, can you have more than one property in an LLC? Yes. But remember, if there's a problem on one of the properties, all of the assets of the LLC can be used to satisfy that creditor. So if you have, if you have a multi-family, if you got a 100-unit multifamily, yeah, you probably should have your own LLC. If you have 3 single-family residences, depends on your risk tolerance. Some people say, I'll just put them in one LLC. Other people say, that's not really a good idea because the liability could exceed the value of that one property, right? And so really this is part of the counseling, the consultative aspect of being a lawyer is we just walk through and we kind of gauge your temperature on, what is your tolerance for complexity, right? Because really that's fundamentally what it boils down to. Can a C Corp hold LLCs for rental property? It could. Again, if a C Corp holds disregarded entities for rental property, then those disregarded entities are reported on the C Corp. If you have real estate in a C Corp, first of all, if you don't have any of this set up and you're thinking, I'm going to set up a C Corp that's going to own a bunch of real estate, you need some advice, okay? And I can't advise you on a Q&A. but you would want to double check that because that sounds like a bad strategy. Now, it might be a great strategy. It just depends. If you have an LLC, if you have a C Corp, maybe grandpa put the farmland in the C Corp in the 1950s, which is very common. And now you've got this land and you're like, how do we deal with this? You need to get your A team together and you need to figure out your options and put together a game plan or not. I mean, part of this is just looking to see what you can do. And do you have the stomach, for lack of a better term, to do it? It's not that it's risky. It just kind of takes headspace. Is a Schedule C for personal taxes? Yes. So Schedule C is on your personal 1040. Well, if you're watching on YouTube, keep watching because it's over, but we're going to have another video pop up. We'll see you later.